Hey, well, hope you're okay. It's Mark Fielding Pritchard here again from M&E Fielding, and we are doing some more IPSAS training. IPSAS, you will remember, are the government accounting standards, which are very, very similar to IFRS. Subject that we're looking at today is good old leases, because wherever you are in the world, whatever you're doing, there's always going to be a lease around. Even when you watch the TV, wherever there are organizations, they'll have photocopiers and so on nowadays, so you need to know about leases. As you can see from this first slide, this is called Leases 2. For leases, we actually have 3 training courses. This is the second one. So Leases 1 looks at what's the difference between an operating and a finance lease. This one will actually go into double entry bookkeeping, because my experience is that most of the people who watch these things are students, so we thought we'd give this one away for free. And then there is Leases 3, which looks at the actual disclosure requirements and what an income statement and balance sheet, and I show my age by using those words, actually look like. So this is Mark from M&E Fielding here, and let's get into our leases. Bearing in mind, we already assume you have the knowledge. What is the difference between an operating lease and a finance lease? If you don't know what they are, go to our website and you can purchase the training there. So slide number 2 that you've got here is a basic revision of course number 1, and it asks you to decide whether or not this particular lease that this ministry has entered into is a finance lease or an operating lease. Hopefully you will know this already, or you will have purchased the training material from us. It's very good quality, if I say so myself. So if you remember the difference, with a finance lease, what's actually happening is that the organization is purchasing the asset. Now, there's a kind of legal shenanigans there because you don't get legal ownership until the end of the lease. But the economic reality with a finance lease is that you are purchasing the asset. And because of that, we talk about this thing substance over form. Because the economic reality is that we are purchasing the thing, we therefore show it in our books and records as our own asset, even though technically, legally, it isn't. An operating lease, on the other hand, is a pure rental agreement. Now, when you look at the accounting standards, here you've got IPSAS number 13, it'll define what a finance lease is, and an operating lease is everything else. If you want a nice little definition or a nice little example, the best way to look at it is motor cars. I think in almost every country in the world now, if you go down to buy a Ford or a Toyota or whatever, they will offer you some kind of lease. Now, when you look at the lease there, fundamentally you are taking a new car, and with that new car you are paying for the car for usually 3 or 4 years. Right? The reality is that you are purchasing that motor car, and that therefore is an example of a finance lease. So where you are purchasing the asset, it's actually a finance lease. An operating lease is where you are renting it. So this is the situation where you go on holiday, you're in Cyprus or Thailand or Panama or wherever for a week, and while you're there you rent a car to drive around in. That is an operating lease. There is no intention or no expectation whatsoever that you are going to end up as the owner of that motor vehicle. So finance lease, you're buying; operating lease, you're renting. So you can read the slide as well as I can, but you'll see there that we have some kind of a machine here, and a ministry is going to lease this thing. The machine has an expected life of 8 years, and there is a non-cancelable lease. Right, notice the word is non-cancelable, so it can't be cancelled, and the period of the lease is 6 years. The lease can then be renewed for a further 4 years, so this is obviously a good old example that I've written myself. So you can see there that the thing can last up to 10 years, and the useful life is up to, yes, you've got it, 10 years. To purchase the machine would normally cost 250 grand, 250,000, and the present value of the minimum lease payments equals 240,000. So once again, you can see that the purchase price, and these are the minimum lease payments. Right, when you're analysing leases, and God forbid I've had to do this so many times, you have to go through and work out what is the minimum lease payment. So, if you're looking at motor cars, you'll see that you pay a certain sum of money every month for, let's say, 3 years. But if your mileage, if your number of miles, number of kilometres goes over a certain limit, you pay the extra as well. With the minimum, we just look at what the minimum is. And finally, so therefore we are paying as a minimum fundamentally the cost of this thing. And the third condition, therefore, is it provides the option of paying $1,000 at the end of 6 years, and it transfers ownership to the lessee. The lessee is the person doing the leasing, who's going to use the asset. Right. When you go through the standard, there's a whole load of criteria. When you look at this thing, really, you're saying, are we actually buying it? We are going to have the asset for fundamentally, almost certain, most of its useful life. We are paying well in excess of 90% of the price of the value of the new asset, and we pay some peppercorn amount. Peppercorn means this idea of a small amount of money. So we pay some smaller money and we take ownership of the thing. Can you see, therefore, that quite clearly we have a finance lease? The intention is that we are going to acquire this asset, whatever it may be, and that we are simply using a finance lease as a way of funding that acquisition. So it's a source of finance for the acquisition. So I hope, therefore, you all agree that it's a finance lease. If you disagree, if you have any questions, if you want to ask about certain variants, go to the website, ME Fielding. You can see it in small letters down there at the bottom side, and send me a question through the contact page. There's also actually on the website some examples of different photocopier leases and what constitutes a finance lease and what doesn't. So have a wee look on the website as well. Right, now on this slide, this is where we start to see the differences between IPSAS and IFRS. You know, a normal auditor working for one of the big four companies would be au fait with their clients having both operating and finance leases. But when you start dealing with governments, and so therefore obviously when IPSAS starts kicking in, when you have governments, when you have charities, when you have NGOs, and when you have international organisations like NATO and the United Nations, you'll start seeing nominal leases. Now, a nominal lease is just the same as a normal lease, so it can be either an operating lease or it can be a finance lease. But the difference is that the amounts of money which are paid are significantly below market value. So if you look at your slide here, it says here if the lease payments are nominal in the first paragraph, then down in the third paragraph it says the Ministry of Health leases a building 99-year lease and it pays $1 a year for a hospital. So as you can see, therefore, this is a nominal lease. Now what we have to do with nominal leases is we have to work through the same classification process as we had before. So the classification process will tell us whether or not it's an operating lease or a finance lease. So if you have a 99-year lease, you're using it as a hospital, can you see therefore that it's going to be a finance lease? Because fundamentally all of the risks and rewards and the full life of the asset, in this case a building, is passing to the Ministry of Health. Now we kind of touched on this before. We touched on this before in that we said that, okay, there's lots and lots of criteria in the standard, but it's not kind of written into stone. You have to use your common sense and say, well, are we really taking over a building or are we just renting something? Now I hope in this example here that it's clear to you that the Ministry of Health is taking on the building as a whole. So therefore we have a finance lease here. So what we have to do with a finance lease, therefore, is we have to recognise the building in the balance sheet, in the statement of financial position, at its full market value. Okay, so we recognise it at its full market value because it's a 99-year lease. And then what we're doing is that the credit for that, because that's going to be debit fixed assets, the credit for that is going to go to revenue because it's donation revenue. So the difference between what you actually pay and the market value will be treated as donation income. So therefore, when you have a finance lease, you debit the value of the asset in the balance sheet and then you will depreciate it over time in the normal way you would with an asset. When you debit that asset, the credit goes to donation income. If you have an operating lease, everything goes through what used to be called the good old profit and loss account. So your statements of full and consolidated gains and losses. So when you have that statement, therefore, what you will do is you will have a debit and a credit equal to the donation. So you work out what's the difference between what the market value is and what we've actually paid. So the difference between what we've paid and what we should have paid, and then you will debit expenses and credit income for that sum of money. So work out the difference between what you've paid and what you should have paid, and then you debit expenses and you credit income, and that's for an operating lease, not a finance lease. But look out for those nominal leases, you'll see them all over the place. And what we don't touch on in this standard, in this training session, but what's really hard is putting a value on them, and maybe that's another training course for you later. If you're interested in that, send me a question through the website. So what we've got here, therefore, is just a revision of the accounting. Now do notice that these are finance leases, and this is in the books and records of the lessee. So at the commencement of the lease, so at the start of the lease, we recognise the asset and the obligation. So you take the value of the asset, assuming that it's a full commercial lease, you take the present value of the minimum lease payments. I hope you all know from your studies what is the present value. So what is today's value? If you don't know what that is, send me a message through the website and I'll get you an answer back on that. You take the present value of all of the minimum lease payments over the number of years. In real life, this really isn't that difficult to do, because in almost every jurisdiction in the world, the government has to, the leasing company has to tell you by law what is the rate of interest that they're charging you over the life of the lease. So you can calculate your lease payments per year, you've got your discount rate, and then you can use your present value tables to discount that back. So it's not actually so hard to do. As it says, therefore, we calculate this is the lower of the present value of the minimum lease payments and the fair value of the asset. So we recognise that the lower of those two, and then if there are other costs such as leasing costs, legal fees, arrangement fees, blah de blah de blah, and banks will always try and sneak these in, you know how they do, you capitalise that as part of the asset cost. So we get this idea that you have at the start debit asset, credit lease creditor, with this single number that's value of the asset, and that value is the present value of the minimum lease payments. It's nearly always that, because you would expect the present value of the minimum lease payments and the fair value of the asset to be approximately the same. That's on day one of the lease. Once your lease kicks in, then what we do is we depreciate it over the shorter of its useful life or its lease term. Right, now notice that phrase, because this will mean that leased assets or assets on finance leases will have to be classified separately in your balance sheet and in your fixed asset registers, because you need to keep them away from the assets that you actually 100% own already. Because notice that your period of depreciation, your useful life, may be lower if your lease term is less than your useful life. Right, every payment that you make is split between capital and interest. So every payment that you make is split between the capital and the interest. Right, I'll show you how to do that with an example in a second. Your closing obligation, your liability, is apportioned between current and long term. It's a liability, so you have to split it between what's due in the short term and what's due in more than 12 months. And that's the same with everything else. Finally, it says executory costs. Right, so these are the costs of insurance and maintenance, your running costs basically of your machine, whatever it is. These are expensed as incurred, and that's the same for everything else. Right, that's the theory. If you kind of having a few questions in your mind, oh my god, what does that mean? Bear with me with the next slides, because we're actually going to do an example and I'm going to show you all the debits and credits. If after you've done the debits and credits you don't get it, watch the thing again. If you don't get it a second time, you already know what to do. Go onto the website, come and find me, whatever. Right, let's do an example with actual debits and credits, and then you can see how it all works then. I apologise if my voice is going as well. The kids have all got bloody coughs and colds. I've got a voice like I've been gargling with razor blades. Right, you can see the example. A ministry leases a machine from a leasing company. The list price of the machine is 110, that should be 110,000 of course, and the present value of the minimum lease payments is 100,000. The rate of interest is 10%, and we're going to pay 28,000 on the 1st of January for 4 years in advance. Right, please notice, really important there, we are paying in advance. Now that's going to have a huge difference to the calculations. If at the end you want to know what it looks like and you can't work it out yourself, what it looks like in arrears means after, come back to me, and then after we've done that, then I can get you a reworked set of slides with it in arrears. But for now it's in advance. Now please remember that. Right, your lease kicks off on the 1st of January 2021, and therefore on the 2021 as well we're going to make a payment, and the payment's 28,000 bucks. So I tried to break it down into steps for you. So the first thing that you do is you recognise the asset on acquisition. So your only question therefore is, what is it worth? Well, it tells you that, remember, it's the lower of the market value or the minimum lease payments. Right, the list price is 110. So that's the assumed market value of the thing, and the present value of the lease payments is 100. So therefore they're roughly the same. If they were a long way apart, you'd want to be asking questions about why. But obviously I've written this example and they're not a long way apart. So you take the lower, remember from your slide? Therefore what we do is we debit the asset 100 and we credit our lease creditor at 100. Nice and simple. Right, that's at the 1st of January 2021. Everybody okay with that? Now, in the ministry, they have taken control of the asset. Remember as well, this idea of substance over form, we don't own it yet, but it's ours. Right, on the 1st of January, therefore, we make a payment. So we're making a payment to the lease company, so we debit the creditor, and let's assume that we pay them cash. So we debit the lease creditor, and we credit them cash. Notice therefore that at the 1st of January, therefore, the balance on your lease creditor is 72,000, being the creditor of 100 for the asset minus the 28 you've already paid. And in your fixed asset register, you have an asset which had a cost of 100. So we saw in the last slide therefore that we acquired the asset on the 1st of January, it cost us 100, and then we paid an immediate payment of 28 to the leasing company, and that's because we're making the payments in advance. Now we're going to jump forward to the 31st of December. For most organisations, so most governments, most charities and so on, once you put your assets into your fixed asset register, then you'll find that your accounting system will calculate your depreciation monthly. But we're going to assume here that the whole of the depreciation is simply calculated at the end of the year. And that's still true for a lot of organisations that keep separate management accounts and financial accounts as well. Before we get to depreciation now, let's have a look at the interest expense, because remember this is a finance lease, so with a finance lease there is an interest cost. So as it says, at the 31st of December 2021, which is the end of the first year, we need to recognise the interest charge. Now how much money have we actually owed all year? Well, we've actually owed 72, being 100 that was the cost of the asset minus the 28 that we've actually paid. So the outstanding debt to the leasing company therefore is 72. Interest is charged at 10%. Remember that that's nice and easy in real life and in exam questions because they have to give you that number. So therefore the interest charge is 7, being 10% of 72. Right, notice how we've rounded it. That rounding will catch up with us at the end of the question because we're going to have a rounding difference because of this. But as far as you're concerned, 10% of 72 is 7. So therefore, look at what we do. We debit the interest expense with 7, so that's an expense in your income statement, and we credit the lease liability, which is 7. So the lease liability has now risen to 79, because if you remember it was 100 minus 28 that we paid, plus the accrued interest, which is 7, gives us 79. And you can see that down at the bottom of the slide. Depreciation, we said that the lease was 4 years, the asset had a cost of 100, so your depreciation expense is 25. So debit depreciation expense, which is an expense, and credit your accumulated depreciation. So when we look at our balance sheet at the end of the year, we see that the asset has a net book value of 75, being 100 of cost minus 25, and the liability to the leasing company is a total of 79. Now, we have to split that 79 between short-term liabilities and long-term liabilities. Right, short-term liabilities, therefore, how much will we pay within 12 months of the balance sheet date? Well, we will pay 28 because it's due, in fact, the next day, the 1st of January 2022. So your short-term liability is 28. How much is your long-term liability? Right, your long-term liability is everything else. So if your liability is 79, 28 is short-term, so you simply 79 minus 28, if my maths are correct, is 51. So your 51 therefore is your long-term liability. So you have an asset, 75, liability, 28 short-term, 51 long-term. And that's the end of the first year. If you can get the first year, then the next 3 years are just straight repeats. Moving therefore into the second year, which is now 2022, 1st of January our ministry pays 28, so again we debit the liability and we credit cash. Our liability outstanding was 79, we just paid 28, so your outstanding liability all of this year, 2022, is 51. Jump forward to 31st of December therefore, your accrued interest expense will be 5, which is 51 times 10%, which gives us approximately 5. So we debit our interest expense 5 and we credit the lease liability 5. Once again, we debit depreciation expense 25, credit accumulated depreciation 25, our expectation being that depreciation is straight line. So therefore in your statement of financial position at the end of, and that should of course say 2022, there's a small mistake on the slide there, your asset now has a net book value of 50 and your liability is reduced to 56, being 79, which was at the balance at the start of the year, minus the 28 paid, plus 5, which is the interest payment. We split that liability 28 short term because that's what's payable within 12 months, and 28, being 56 minus 28 is 28. So the second 28 is long term. So it's just coincidence that they're both 28. Your total is 56, your short term is 28, so the balance, which just happens to be 28, is your long term liability. More of the same, more of the same. So 2023 now is our third year. So once again, 1st of January we pay our cash. You should be getting used to this now. It's the third year that we've had the same entry, so we debit the liability. Our balance outstanding therefore was 56 at the start of the year. We just paid 28. So therefore we have an outstanding balance of 28, and that's the balance which is outstanding through the whole of the year. The interest at 10% gives us therefore a liability of 3. So our accrued interest is 3. So accrued interest is 3. Depreciation expense once again is 25. Accumulated depreciation charge again, which is our credit, which isn't shown there, is 25. So therefore in your statement of financial position at the end of the year, which is 31st December 2023, we have an asset which is 100 minus 75, which gives us a net book value of 25. Our liability is 56, which was the balance at the start of the year, minus the 28 payment, plus our interest, which was 3, which gives us a liability of 31. So going into our final year, therefore, our short-term liability we will show as 28, and our long-term liability we will show as 3. If that doesn't make sense to you and you think, well, next year's the last year, we should show all the short-term, then I'll buy that argument. So you could show short-term as 31 as well. Okay. So our fourth and final year. On the 1st of January, the ministry pays 28,000, as the slide says again. Right, now this time it's the last payment, yeah? So we debit the liability 28, we credit the cash 28. I hope you all understand now that it's paid all of its liabilities. Everything has been paid. Therefore, there is no balance due. So the interest for the final year is 0 because all of the money has been paid. When we get to the end of the year, therefore, there's no calculation to do for interest. The liability has been completely paid off. We still need to calculate our depreciation though, because the asset has been only depreciated for 3 years, so we will debit depreciation expense and credit accumulated depreciation 25 the same way that we have every year. Now those of you that were paying attention to slide number 8 will notice that the liability that we had brought forward was not 28 but was 31. Now this has occurred because we have a rounding difference. In reality, what will happen is that they will not pay a nice round sum of money. There will be something in change, and you can calculate that using annuity tables. What's happened is I just calculated this very roughly, and we've ended up with the fact that it looks from our accounting records as if we haven't paid all of our liability. So we need to get rid of that liability of 3. So to get rid of a liability of 3, we debit it, and the credit therefore needs to go to interest income or whatever, because in fact it's the correction of an over provision of interest expenses. And I hope that was interesting and useful for you, is how the lessee, get this right, how the lessee accounts for a finance lease in his books and records. Okay, if you have any questions on that, if you want to know what happens if we pay in arrears, if you want to know what happens to the lessor, if you want to know what happens to nominal rents, you know where the website is. Send me an email message and I'll do my best to answer you. Thanks very much for listening, and if you're using this for exam purposes, best of luck with your ACCA or your ICAEW IPSAS exams or whatever you're doing. Bye bye now.